Okay, just think about your day to day. How many times have you, clicked buy now or subscribed to something, maybe ordered food online? E-commerce is just, it's everywhere.
It really is.
But do you ever stop and think, how does that simple click, that quick digital buy, actually turn into lines on a company's financial statement? It seems so complex.
So it definitely is a challenge. I mean, the way these digital businesses operate, the speed, the models, it really pushes the edges of traditional accounting. You're not just selling like a physical thing over the counter.
Right.
You've got subscriptions, ads, digital items, these huge marketplaces with third parties involved. All this data, it's a lot.
Exactly. And that's why today we're doing a deep dive into this really important guide. It's from the Institute of Chartered Accountants of India, the ICAI, and it's called the Guidance Note on Accounting by E-commerce Entities.
Yeah, this is basically the playbook,
Yes.
The accountants working inside those big online companies you use every day. This is what helps them figure out how to apply the accounting rules to all these, newer kinds of situations.
And what I found really interesting is that this guide, it didn't just pop up yesterday. It actually grew out of an older one they had for .com companies way back.
That's right.
It just shows how accounting has to keep changing, reacting to how technology changes business.
Absolutely. I mean, e-commerce changes so fast. The accounting rules have to evolve too, just to make sure the financial reports actually reflect what's really going on with the business.
So our mission here really is to pull out the key insights from this IKEA note. We want to give you a kind of shortcut to understanding the financial plumbing of e-commerce straight from the source. What are the big takeaways?
Okay, let's get into it. Let's unpack this.
All right. So where do we begin? What does this guidance even count as e-commerce? And what kind of businesses does it cover?
Well, at its heart, the definition is pretty simple. Buying and selling products or services over the internet. It specifically calls out the tech involved, mobile commerce, electronic payments, internet banking, all that stuff. You can think of it like, a digital version of the old mail order catalogs, but obviously much more dynamic.
And it's not just companies selling directly to us, right? The scope is wider.
Oh, yeah, much wider. The note covers the main market segments. You've got business-to-business, B2B, so companies selling online to other companies. Then business-to-consumer, B2C. That's probably what most people think of first, like your Amazons or Flipkarts. Then there's consumer-to-consumer, C2C. Think platforms like OLX or eBay, where people sell stuff to each other, and the platform just facilitates. And even consumer-to-business, C2B, like a Priceline model, where you might bid for a hotel room and businesses compete for your offer.
Wow. Okay, so it really covers that whole digital marketplace and the transaction itself. It's more than just clicking pay, isn't it? What are the key parts?
Right, the guidance breaks it down. You've got the actual product or service, obviously.
Right.
The platform, the website, or the app. How you find stuff, so browsing. How you place the order. The payment system, and interestingly, they specifically mention cash on delivery is still a big factor, not just electronic payments.
This is relevant, yeah.
Very. And then all the back-end stuff, shipping, handling returns, warranties, customer support, all of that's part of the picture.
That really shows the complexity behind what feels like a simple online purchase. Now, this guidance note, it's not like a complete accounting manual for these companies, is it? It's quite specific.
Exactly. Its scope is focused. It's looking at the unique accounting issues that e-commerce businesses face, particularly around when and how to recognize revenue and expenses. It applies to companies, LLPs, partnership firms, following certain Indian accounting standards. It doesn't rewrite basic accounting, but it interprets how the existing rules, like AS9, apply in this specific context.
Okay, so let's zero in on maybe the biggest area, revenue recognition. Why is getting this right so incredibly important for e-commerce companies?
Well, this is fascinating because for a lot of these companies, especially when they're growing fast, revenue is often the key number everyone looks at. Investors, analysts, they use it to value the company.
Right, the top line growth.
Exactly. So how they report that revenue, the timing, the amount, it's not just an accounting detail. It directly affects how the market perceives their size and potential. Getting it right is absolutely critical.
And the note mentions several ways these companies make money, not just selling goods.
Yeah, the main ones listed are merchandising, so selling actual stuff, membership or subscription fees, advertising services like banners or sponsored results on their site, and other services, maybe like web hosting or something similar.
And the basic rule for recognizing revenue, that comes from Accounting Standard 9, or AS9.
That's the foundation, yes. AS9 basically says you recognize revenue when you've done your part, delivered the goods, or provided the service, and when you're reasonably sure you're going to get paid.
Okay, sounds straightforward enough. But applying that to e-commerce, that's where the tricky part comes in. And one of the absolute biggest issues the note tackles is this question of gross versus net revenue recognition.
Ah, yes. This is probably the critical question, especially for marketplace platforms. Should the platform report the entire amount the customer paid as its revenue? That's gross. Or should it only report the commission or fee it earned for making the connection? That's net.
And the difference could be huge for their reported size.
Massive. It dramatically changes how big the business looks on paper.
So how does the guidance tell companies which way to go, gross or net?
It really boils down to whether the e-commerce entity is acting as a principal in the deal or just as an agent. If you're the principal, you recognize the gross amount. If you're just the agent connecting buyer and seller, you only recognize the net amount, your fee or commission.
Okay, principal versus agent. What makes you a principal then? What are the signs?
This is where the guidance gets really helpful. A principal is usually the one taking on the main risks and rewards of the sale. So the note lists specific things to look for. Are you the main one responsible to the customer? Like, who does the customer complain to? Do you set the final selling price?
Okay.
Do you have inventory risk, even if it's just for a short time, or risk of returns? Do you modify the product or perform a big part of the service yourself? And crucially, do you carry the credit risk if the customer doesn't pay?
Right. Let's use that example from the note, the e-tailer one. It really brings this to life. The one where they buy from a wholesaler only after getting a customer order.
Yes, that's a great one because it challenges the simple view. You might think, okay, they don't hold stock beforehand. They must be an agent. But the guidance says, hold on. This e-tailer could still be the principal.
Even without holding the inventory before the order comes in. Huh.
Because they might be taking on other key risks. They're the primary contact for the customer, the one responsible for making sure the order gets fulfilled. They often control the final price the customer pays. And critically, they might be the one who has to deal with returns, a huge risk in e-commerce.
Ah, the returns risk.
Exactly. And they might bear the credit risk too, depending on payment terms. So even without having a warehouse full of stuff beforehand, these other factors controlling the transaction, bearing key risks like returns and credit loss, can make them the principal. So they'd report the gross revenue. It really shows you have to look at the substance, not just the surface level flow of goods.
That makes so much sense. You can't just assume based on whether they have a big warehouse. It's about who carries the risk and responsibility.
Precisely. It's about the economic reality of the transaction.
Okay, let's talk about some of those other specific revenue streams.
Right.
What about membership and subscription fees? Lots of services use those.
Right. So if a customer pays a non-refundable fee up front, maybe for a year's access or a lifetime membership, the guidance is clear. You generally don't recognize all that cash as revenue immediately when you get it.
So it gets deferred. You spread it out.
Exactly. It's deferred revenue. You recognize it systematically over the period you're actually providing the service. Usually that's straight line, just evenly over the year or whatever the term is. Or maybe based on usage. That makes more sense for how the customer gets the benefit. The point is matching the revenue to when you deliver the service.
That makes sense. Earn it as you provide it. What if the fee is refundable?
If it's refundable under certain conditions, you'd initially record it as a liability. Only when the conditions for the refund expire does it potentially become revenue. And for simple periodic fees like a monthly subscription, you just recognize it over that month.
Got it. How about auction sites, like those C2C platforms? How does their revenue work?
They typically have two main types of revenue. First, listing fees, what a seller pays just to put an item up for auction. That fee is recognized as revenue over the time the listing is active.
Okay.
Second, transaction fees. That's usually a cut, a percentage of the final selling price when the auction is successful. That fee is recognized only when the sale actually completes and the platform has done its part in facilitating it.
And shipping and handling, almost every online order has that. How is that treated?
It depends a bit on how it's presented. If the shipping cost is just baked into one single price for the item, well, then it's just part of your total sales revenue. If it's listed as a separate charge to the customer, then generally you'd record it as separate income.
Okay.
But there's a key point in the guidance. If that separate charge is really just a direct pass-through, meaning you're charging the customer exactly what the shipping company charged you, and if it's a significant amount, you might actually show it as a reduction of your shipping expense rather than booking it as revenue.
Ah, so it doesn't inflate both your revenue and your costs unnecessarily.
Exactly. It just nets out, showing the true cost of shipping you bore. Makes sense if it's just a reimbursement.
Okay. What about when companies bundle things together, like software plus ongoing support. The note calls them multiple element arrangements.
Yes, this happens a lot. You pay one price for a package deal that includes maybe an initial product or service plus some future stuff. The web hosting plus ongoing maintenance example in the note is classic. The main idea here is you have to unbundle it.
Unbundle the different parts.
Right. You have to take that total price the customer paid and allocate it to the different distinct things you promised to deliver within that bundle. And the allocation is based on the separate fair values of each part.
Fair value meaning what they'd sell for on their own.
Pretty much. You need objective evidence, like what you charge other customers for just the hosting or just the maintenance when sold separately.
So using that hosting example, they can't just book the whole payment up front when the customer signs up.
No, definitely not. So, in the notes example, say the bundle costs 15 lakh, but maybe standalone hosting for the period is worth 12 lakh and standalone maintenance is worth 6 lakh. You use those relative standalone values to split the 15 lakh you received. The calculation in the note allocates 10 lakh to the hosting revenue, which gets recognized over the hosting period, say a year, and 5 lakh gets allocated to maintenance revenue, recognized over the maintenance period, say 6 months.
Right, so the revenue timing matches when each specific service is delivered.
Precisely. It prevents recognizing revenue too early for services you haven't provided yet.
Okay, that example really helps clarify the unbundling. Now let's talk about something huge in e-commerce, returns. How does accounting handle the fact that stuff often comes back?
Yeah, returns are just a massive part of the business model, and the accounting has to deal with that reality. As 9 says, companies need to look at the substance of their sales, what's likely to happen, and make a provision for expected returns based on their past experience, historical data. You basically can't recognize revenue for sales you reasonably expect to get returned.
Okay, so you estimate returns. But does it matter how the customer gets compensated, like cashback versus store credit or an exchange?
Yes, the guidance makes a really important distinction here. If the return is for cash back, the accounting is essentially to reduce the amount of sales revenue you recognize up front by the estimated value of those cash returns. And at the same time, you put an asset on your books for the estimated cost of the inventory you expect to get back.
Okay, let's use the shirt example from the note for that cash return scenario.
Right, so imagine you sell shirts for $1,000. Based on your history, you expect 10% or 100 worth will be returned for cash. Let's say your cost for those shirts was 95, a 5% margin. When you make the initial sale, you don't book 1,000 revenue. You'd book 900, 1,000 minus the 100 expected returns. And you'd also record a current asset of 95 for the cost of goods you anticipate getting back.
And then you adjust later if actual returns are different.
Exactly. If, say, only 80 words actually get returned within the return window, you'd adjust the initial estimates. That extra 20 that you initially held back from revenue would then be recognized as final sales and the related asset adjusted.
Okay, that makes sense for cash returns. You sort of reverse part of the sale up front. But the note says if the return is for other goods or store credit, it's different.
Yes, this is a subtle but key difference. If the customer gets store credit or exchanges the item, the guidance generally treats the original sale as effective. You recognize the full 1,000 revenue up front in our example. However, you still need to consider the potential loss you might incur when you resell or deal with that returned inventory.
So it's not a revenue reduction, but a provision for a potential loss on the returned goods.
Correct. You only make a provision for an expected loss if the amount you think you can resell the returned item for is less than what it originally cost you.
Okay, walk us through the toy example for that one.
Sure. Sell a toy for 1,000. Its cost was 80. You expect 10% or 100 worth to be returned for store credit. The cost of those returned toys is 80. Now, the key question, what can you resell those returned toys for? If you estimate you can resell them for, say, 90, which is more than their 80 cost, then no loss provision is needed. The original 1,000 sale revenue stands.
Okay.
But if you estimate you can only resell them for 70, which is less than their 80 cost, you have an expected loss of 10. 80 cost minus 70 resale value. In that case, you would make a provision for that expected loss of 10. The 1,000 revenue is booked, but you also book a 10 provision for loss separately.
Wow. That distinction based on whether you expect to get your cost back on resale is really crucial. It means companies need good data, not just on return rates, but on the likely resale value of returned goods.
Absolutely. It's
Yep.
all about assessing the future economic impact of those returns.
Okay, let's shift gears a bit. Let's talk about some key expenses and operational things the guidance touches on. Website and mobile app development costs, are those assets you build up over time or just expenses you take right away?
Good question. For the initial platform, The very first website or app you build, the costs you incurred during that development phase, before it's actually live and working for customers, are generally capitalized. They become an intangible asset on your balance sheet.
Okay.
This includes things like planning the site, designing it, coding, testing, all the work up until it's ready to go live.
And once it is live, what happens to those capitalized costs?
Then you start amortizing them, basically spreading the cost out as an expense over the asset's useful life. Given how quickly tech changes in e-commerce, the guidance suggests a pretty short life, maybe 3 to 5 years typically, because these platforms can become obsolete quite fast.
Right. What about all the costs after that initial site is up and running? Maintenance, updates, maybe building a second app?
That's the key difference. Cost for just ongoing maintenance of the existing platform, or cost to develop completely new sites or apps after your first one is already operational. Those are generally treated as operating expenses, hitting your profit and loss statement immediately as they happen. The guidance actually has a helpful list in an appendix, showing examples of what's initial development versus what's ongoing expense.
That clarifies the line nicely. Okay, what about all the rebates, discounts, and incentives that e-commerce companies are constantly offering? Are those treated as less revenue, or are they a marketing cost?
It kind of depends on what they are. If a discount or rebate is directly tied to a specific sale, making the price lower for that customer, or maybe it's an introductory offer on a product, then it's usually treated as a reduction of turnover. You just show less sales revenue.
Okay.
But if it's more of a general incentive, maybe like loyalty points given out for overall activity that aren't directly reducing the price of this specific sale, it's more likely to be classified as a marketing expense.
Speaking of marketing, ad spend. E-commerce companies spend fortunes on advertising. Is there ever a case to, capitalize some of that cost, arguing it builds the brand long term?
That's something management might wish for. But the accounting guidance, reflecting standard principles, is pretty firm here. Advertising costs are almost always expensed as incurred, right when you spend the money.
Even if it feels like it has future benefits.
Yeah. While you might believe it builds the brand for years, it's usually too hard to reliably measure that future benefit in a way that meets the accounting criteria for capitalization. So those huge ad budgets generally flow straight through the P&L each period.
That definitely impacts reported profits quickly then. What about just managing the inventory itself, the physical goods?
That's a huge operational challenge that has accounting consequences. Many e-tailers deal with vast amounts of inventory, often with pretty thin margins. If your internal controls over that inventory, tracking it, storing it properly, handling it are weak, you can easily end up with damaged goods, lost items, or stock that just becomes obsolete really fast because trends change. All of that leads to inventory write-downs, which directly hit your profits.
And many use third-party logistics providers, 3PLs, to handle warehousing and shipping. How do they factor into the accounting?
They impact things in a few ways. First, when you can recognize revenue might depend on their processes, especially with cash on delivery, maybe risk-only transfers when the 3PL collects the cash. Second, they help manage the risk of handling all that cash for catter orders. Third, how they charge you affects how you recognize your fulfillment costs. And importantly, when someone else is holding your inventory, you need really strong controls to make sure it's actually there and properly accounted for, like verifying their counts.
You mentioned cash on delivery again. The note specifically flags risks there too, right? Beyond just logistics.
Absolutely. Handling large amounts of physical cash, especially through delivery agents, brings risks like theft or simple mistakes that you don't have as much with digital payments. So the guidance suggests important internal controls. Things like closely monitoring the collection agents, separating duties so one person doesn't handle everything, making sure cash is deposited daily, doing surprise checks, and maybe getting insurance.
Okay, let's tackle what seems like maybe the most complicated area the guidance covers. Point and loyalty programs. Everyone seems to have one.
They are incredibly common, yes, and the schemes can be quite varied. You might earn points and spend them with the same company or maybe with partners, or sometimes through a completely separate third-party company that runs the program.
And the big accounting headache is, how do you account for the value of those points you give out? You got money for the sale, but you also made a promise for the future.
That's exactly it. How do you split the value? The guidance talks about two main ways to approach this under AS9. There's an older method called the provision model and a newer, preferred one called the deferment model.
Okay, tell me about the provision model first. How does that work?
With the provision model, you basically recognize all the revenue from the original sale, the one where the customer earned the points right away. Then you look at your history and estimate how many of those points you think people will actually redeem and what it will cost you to provide the reward when they do. You create a provision, which is basically booking an expense now for that estimated future cost of redemption.
So book all the revenue now and book the estimated future cost now. Simple enough, maybe. What about the deferment model?
The guidance calls the deferment model more refined. The idea here is that when you make that initial sale, part of the money you receive isn't really for the item sold today, it's for the future benefit represented by the points. So you defer recognizing a portion of that initial revenue.
Okay.
That deferred amount represents the estimated value of the points you issued. Then you only recognize that deferred revenue later as customers actually redeem their points, or maybe as your estimates about redemption change over time.
Why is that considered more refined? What's the benefit?
The thinking is it provides a better match between revenue and when you actually fulfill your obligation. You didn't just sell a product, you sold a product plus a promise of a future reward, the points. The deferment model tries to recognize the revenue related to that future reward only when you actually deliver it, i.e. when the points get redeemed.
That sounds more theoretically correct, I guess, but maybe harder to actually do in practice.
It definitely can be more complex. You need to estimate the fair value of those points or award credits. That requires good data on things like how many points people are likely to redeem, what the rewards cost, and what the standalone value of those rewards is. The guidance does say if you just don't have reliable enough data to make those estimates, the provision model might still be acceptable under AS9.
Okay, let's try to make the deferment model clearer with the example from the note. Numbers always help.
Absolutely. So say entity A sells something for 150, and as part of that, the customer gets 120 loyalty points. Entity A knows that typically 1,000 points can be redeemed for goods that would normally sell for 60. So the fair value of 1 point is roughly 0.06. 60 divided by 1,000.
Okay.
The total fair value of the 120 points issued is 7.20, 0.06 times 120. But entity A looks at its history and estimates that customers will probably only redeem 100 out of those 120 points on average. So the estimated fair value of the points they actually expect to have to honor is 6, which is 7.20 times 100, 120.
Right. 6 is the value of the expected future obligation. So how does that affect the initial 150 sale accounting?
This is the core deferment step. When entity A makes that 150 sale, they don't book 150 as revenue right then. They book 144 as sales revenue. 150 total minus the 6 estimated value of the loyalty points. Yep. The remaining 6 is recorded as deferred revenue. That's a liability on their balance sheet, representing the promise to provide something later when points are redeemed.
And then how does that 6 eventually become revenue?
As customers start redeeming those points, let's say in year 1, customers redeem 50 of the points from that batch. Since the initial expectation was that 100 points would be redeemed in total, the revenue recognized in year 1 from the deferred amount is 3. That's 50 points redeemed divided by 100 total expected points, multiplied by the 6 total deferred revenue.
Got it.
So the deferred revenue liability goes down by 3, and sales revenue goes up by 3 in year 1. And of course, there'd be a cost of goods sold related to the rewards given out. The note also explains that if your estimate of the total points expected to be redeemed changes in later years, you adjust the subsequent revenue recognition based on that updated estimate.
Wow, that is definitely more involved. You need ongoing tracking of redemptions and potentially re-estimating things.
It really is. More complex, yes, but arguably gives a truer picture of when the company earns the revenue related to those loyalty points.
And the note also mentions what happens if a third party runs the loyalty program.
Right. Sometimes the company issuing the points, say website A, might pay another company, like Rewards Ltd., a fee to handle the whole redemption process. Rewards Ltd. Takes on the obligation. In that case, website A has essentially outsourced the liability.
So website A's accounting is simpler?
Yes. Because they've transferred the obligation, they would typically recognize the full revenue from their original sale immediately. The fee they pay to Rewards Ltd. Is just an expense for them. Rewards Ltd. Then has the deferred revenue liability and recognizes revenue as they fulfill the redemptions.
It's incredible how complex the accounting gets for something consumers see as just free points. It really shows the variety of business models and their financial implications.
It absolutely does.
Okay, just a couple more important points before we wrap this up. Equity-based consideration. Why would an e-commerce company pay for things with its own stock instead of cash?
Well, especially for startups or companies in a high-growth phase, cash can be really tight, so they might issue shares or options to buy shares, to pay for essential services, maybe marketing help, tech development, or even just to compensate key employees or partners. It's a way to get things done or build relationships when you don't have the cash on hand.
Makes sense. And how does the accounting work for that?
The main principle is you try to measure the transaction based on the fair value of the goods or services you received. So if you get, say, $10,000 worth of marketing services and pay with stock, you'd ideally record a $10,000 marketing expense and an increase in your equity.
Okay.
However, the guidance points out that sometimes it's really hard to reliably figure out the fair value of the services you received. If that's the case, you then look at the other side. What's the fair value of the equity instruments you gave away, the shares or options, on the date you received the service or goods? That becomes the value you record.
So if you can't reliably value what you got, you value what you gave up.
That's the fallback, basically. Though the ideal is still to measure based on what you received, if possible.
And finally, what about disclosure? What do companies need to tell people in their financial statement notes about all this?
Well, beyond the usual requirement to disclose your main accounting policies, the note really stresses transparency, especially around how you arrived at fair values for these complex areas. Things like how you allocated revenue in those multiple element bundles, or how you valued advertising you swapped with another company, barter, or how you value that equity compensation we just talked about.
Right, because those values can involve judgment.
Exactly. Since there can be estimation and judgment involved, explaining how you came up with those fair values is really important for anyone reading the financial statements to understand what the numbers actually represent.
Wow. Okay, this has been a seriously deep dive. We've gone from just clicking buy all the way through to how that translates into revenue, the complexities of returns, loyalty points, website costs, even paying with stock. It's intricate.
It really highlights the challenge, doesn't it? Trying to fit these incredibly fast-moving, innovative e-commerce business models into the structured world of accounting standards. It takes specific guidance like this and a lot of careful judgment.
And for you, the listener, understanding these principles, even at a high level, gives you such a better lens for looking at the financial health and the business models of all those online companies you interact with every day. It's not just about that big revenue number you see in the headlines.
Right. It's about how they got to that number, what assumptions are behind it, what promises or risks might be sitting on their balance sheet as liabilities or provisions.
Which leaves us with a really interesting thought, doesn't it? E-commerce never stands still. Business models keep evolving online. What's the next big thing? What new digital service or business model is just around the corner that's going to give accountants the next big headache, forcing them to figure out how to capture its economic reality in the financial statements?
That's the constant challenge. The digital world moves fast, and accounting principles have to keep pace to provide that true and fair view.
A fascinating thought to end on. Thanks so much for walking us through this complex but really crucial guidance.
My pleasure. It's important stuff.